Good afternoon, everyone. Thank you for joining us in the last session of day 4 of the 36th Annual Conference of the African Union for Housing Finance. I have the pleasure of introducing Lucia Schlemmer, Senior Research Analyst at the Center for Financial Regulation and Inclusion. Welcome, Lucia. Thank you for joining us.
Thank you so much for having me.
Thank you. You are joined by Munia Tagba, the advisor at the Affordable Housing Institute, head for Middle East and Africa. Thank you so much for joining us, Munia.
Good afternoon, everyone.
Good afternoon. The topic of this session is ensuring housing and infrastructure in an increasingly risky world. A very important topic for all of us here. And we have 60 minutes. We will start with a presentation from Lucia and then have a conversation between Lucia and Munia. Please, for the participants, feel free to write your question in the chat session, and I will read them at the end. We can have a Q&A at the end. I will read them to Lucia and Munia. So without further ado, Lucia, I'll let you jump right into it. Do you have a presentation? Would you like to share your screen? Okay.
Yes, I'll share my screen now.
Thank you very much.
Perfect.
Thank you, Olivier. While Lucia is sharing her screen, I'll just remind that she works with Senfree and she will say more about it in her presentation. She's a senior researcher at Senfree and she's part of the team whose work is to strengthen insurance products across markets in Sub-Saharan Africa. There's a background noise. I'm not sure where it comes from.
Lucia, can you mute your I think the echo comes from, if you can just mute. Go ahead, Munia.
Thank you.
Yes, it's just the echo. Thank you so much.
Okay. And Lucia has done a lot of analysis on the role of the financial sector in promoting urban resilience and climate risk adaptation. She also has done technical assistance to insurers to expand the reach of insurance and make it more inclusive. So to you now, Lucia, we look forward to your presentation and to hearing more about your work in Senfree.
Perfect. Thank you so much, Munia and Olivier, for the introduction. And thank you again, everyone, for joining the discussion today. So I'd like to first start off by telling you a bit more about Senfree and what we do. So we're a non-profit think tank based in Cape Town, South Africa, and we're focused on promoting financial sector development and inclusive growth across Sub-Saharan Africa and other developing markets. And we do this by working with both financial sector providers and regulators. So we have a partnership with Financial Sector Deepening Africa, and we've established a program called Risk, Remittances and Integrity. So as Munia mentioned, I'm part of the risk team, which focuses on broader insurance market development and the role of inclusive across Africa. Some of the key themes that we cover include microinsurance, insurtech, and their impact on market development. And we also provide support to regulators to adapt to changing environments. We also have a risk and remittances and integrity streams who work to reduce average remittance costs across Africa and promote remittance flows, and also ensure that financial inclusion follows a risk-based approach to reduce money laundering and terrorist risks. So as mentioned, I'll be presenting on the role of insurance in property markets, looking at how insurers and housing stakeholders can best mitigate the various risks existing in Africa's housing and infrastructure sectors through an efficient insurance system. So I'm first going to provide a bit of background on the problem. So property markets are important for economic development and resilient cities, and this happens both directly and indirectly. Directly through increased activity in property markets, which supports GDP growth and employment through new construction, the supply of materials and equipment, renovation, maintenance, and the provision of real estate services. And property markets also indirectly support development by building resilient communities and cities. However, there is a severe housing and infrastructure deficit in Africa. So as I'm all sure we know, Africa is often regarded as the fastest urbanizing region, So the urban population is projected to reach about 1.2 billion by 2050, which means that 60% of Africans will be living in cities by then. And this fast rate of urbanization has outpaced both the growth in housing and the capacity of authorities to maintain and expand existing infrastructure and provide essential services. So in Africa, there's an infrastructure deficit of about $1.4 trillion, and over 50 million housing units are needed to plug the affordable housing deficit. In addition, cities in low and middle income countries have struggled to respond to rapid urban growth with adequate infrastructure building. As a result of this, millions of people around the world live in unplanned, underserviced neighborhoods, and these individuals are also often located in the more hazardous parts of cities. So about 53 million individuals, which equates to about half of the urban population, currently live in urban slums across sub-Saharan Africa. So there is a distinct need for risk transfer mechanisms and for financing, both of which insurers can provide. However, in practice, there is insufficient insurance participation in property markets across Africa, and insurance markets are relatively underdeveloped. So insurance penetration in Africa was under 3% in 2017, and across the region, about less than 10% of adults have private insurance, despite the fact that more than half of them faced an insurable risk in the last year. So urban property markets continue to be underserved by insurance, despite the increasing demand for property, the presence of property developers, and access to capital. In addition, unfortunately, the current insurance business model for underwriting physical assets in cities is becoming increasingly unsustainable. So insurers have highlighted that existing data and models they use are increasingly ineffective at predicting losses from disasters, and the models that they do use are historic in nature as opposed to forward-looking, which makes it more difficult for them to predict future risks. And the risks that cities do experience are further exacerbated by the already poor infrastructure and capacity limitations. So the uncertainty and inaccuracy from these models prevent insurers from correctly estimating potential damages, which in turn increases premiums, or even worse, makes the risk event uninsurable, which can have extremely dire effects on investment. So I'm now going to turn to some of the main roles that the insurance market can and should be playing in property markets. So the first is risk transfer, and this essentially refers to the fact that insurers absorb the impact of risks and transfer capital to support the recovery of communities and infrastructure. Through this function, insurance essentially helps businesses, communities, and individuals to recover from risks that they face. So in addition to transferring these risks, this allows insurers to provide economic agents with a more stable basis for planning, which promotes entrepreneurial activity and can enhance the willingness of property market actors to undertake more risky ventures while protecting innovators and investors from shocks. So the second function that the insurance market plays is really around risk management. So insurance has a key role in building appropriate risk management systems. And this refers more to the preventative measures that can be put in place to either limit the impact of risk events on property or mitigate the risk event from even happening. So insurance does this by generating information and data, establishing collaboration structures, building risk management capacity, and ingraining risk mitigation measures. So an example of this would be that they require fire extinguishers and fire drills on all building sites. In addition, insurers can require that risk management plans be put in place before they even provide an insurance product or agree to cover certain risks. And this really incentivizes individuals and businesses to change their behavior and become less risky, essentially. The final role that insurance can play in property markets relates to building resilient assets. So through insurers' role in mobilizing, pooling, and allocating capital, underwriters support infrastructure and capital investment and can support the development of instruments to provide investment in sustainable buildings and infrastructure. So just to expand a bit more on the mobilizing, pooling, and allocating of capital functions, so insurers essentially mobilize capital by either collecting premiums from individuals and businesses or by enabling investment. So when they mobilize this capital, they essentially accumulate significant funds which they can invest. And larger funds are more efficient to manage and invest, and they also allow for greater diversification. So this enables insurers to more effectively allocate capital to productive opportunities than individual investors can, for example. And they can also invest over longer time horizons and are able to build professional skills and data to manage these assets. Through these functions, insurers really contribute towards growing the professional investment industry. And this in turn can advocate for reforms in governance, auditing, and accounting practices, which is critical for investment decisions and also promotes global and domestic business confidence. So for the purpose of this presentation, I'm going to really focus on the first two roles of insurance, so the risk transfer and risk management functions. So on this slide, I've provided an overview of some of the main risks and constraints that housing and construction markets face. So it's useful just to note up front that all construction and housing markets face challenges, but in developing countries specifically, these difficulties and challenges are present alongside a general situation of socioeconomic stress, chronic resource shortages, institutional weaknesses, and a general inability to deal with the key issues. So the first risks are just administrative risks and schedule delays. So in Ethiopia, for example, about 40 to 60% of construction projects experience delay. And these risks arise mostly due to inefficiencies around the implementation of policies in municipalities, and they can result in cost overruns, lost profits, and the postponement of property developments. The next major risks are financing and credit risks. So I think we're all aware that in most markets, there is a lack of financing for housing construction and purchase. So in Kenya, less than 30% of urban households can afford to purchase a newly built home with mortgage financing. And this figure drops down to only 3.5% of Uganda's urban households. The next large risk is skilled labor shortages and informality. So this poses risks to both the design and construction of housing and infrastructure projects. And it's a particularly salient risk across Africa. So the African Development Bank reported that about 75% of artisan builders are not formally or adequately trained. And in South Africa, we have a slightly different challenge regarding the delivery of houses. So after apartheid, there were what is known as RDP houses rolled out to the low income population. And a lot of these houses were defective. So I think about 40,000 houses were defective and had to be flattened and rebuilt at a cost of more than 1 billion rand due to poor quality and poor building practices. And related to this are risks around theft and damage. So these risks arise during the construction, use, and maintenance of property. And as I just mentioned, poor design, construction, and building practices often contribute to structural damages or structural problems that result in damage to property. So again, using Kenya as an example, drawing on data from a sample of neighborhoods showed that less than a third of buildings actually comply with land use plans and regulations. And I think between 1996 and 2017, Kenya's major cities reported 26 cases of major building collapses. So on the theft, in South Africa, it was found that construction site theft costs about 1 billion rand each year. And the best estimate suggests that only 6% of stolen construction equipment is ever recovered. So the last two risks that I'd like to touch on today are just related to rather external risks that have an impact on housing and construction markets. So these are firstly environmental challenges. So the number of climate-related disasters has steadily been increasing and getting worse due to changes in global warming, temperatures, which means that infrastructure assets will be exposed to weather events that are more extreme and less likely to predict than ever before. So, for example, Lagos experiences annual flooding due to poor drainage, as well as purely seasonal flooding and coastal flooding. So in 2012 alone, about 40% of urbanized regions in Lagos experienced floods, and these cost about $200 million worth of damage to goods and properties. The last risks that I'd like to touch on are just political and macroeconomic challenges. So these essentially just raise or discourage investment, raise costs, and decrease rental demand. And furthermore, an unstable political environment may further exacerbate macroeconomic risks, particularly when there are concerns about land rights, approvals, and tenure required for development, which again just disincentivizes investment activity. So here we can see some of the insurance solutions that have emerged. So some of these are quite straightforward. So, for example, insurance which covers theft or accidents, for example, if a worker gets injured while working on site, or insurance to just cover your home or your contents. Then there are more complex products. For example, at the top, you'll see advanced loss of profits insurance, which essentially provides cover for financial losses due to delays in construction and infrastructure projects. Then there's also products which cover the financial risks, for example, such as credit insurance, which covers the event that a borrower is unable to repay their loan, or a performance bond, which is essentially a guarantee that a contractor will complete a project. But as I mentioned, insurance markets across Africa are underdeveloped, which often means that these products don't exist or are limited. And it's also important to realize that property development is inherently a risky business, and insurance cover is likely not to provide cover for all of these risks, especially if sound risk management is not applied by all the parties involved. And this was found to be an issue not only in developing, but also developed markets. So a study of the risk management practices of 69 leading real estate development firms in Europe found widespread fragmentation, a lack of formalization and coordination, as well as a disjoint between individual risk management and the risk appetite of the organization to be key issues. And while it's unknown what these kind of figures are in Africa, a lack of internal risk management really undermines the viability of property market-related insurance to be a focus area for insurers. So at Senfree, we've done some research on the innovative solutions which have emerged to address risks in the housing and property sector. And we've also looked at how these solutions are helping to expand the reach of insurance. So in 2019, we did a global review of construction platforms. And these are essentially digital platforms that connect different actors in the construction space. So if you think of Uber, which is an example that I can think everyone would most likely know of, it would be like an Uber, but for construction. So these platforms are essentially serving as new ways for insurers to connect with customers and reach individuals that would be typically difficult to get a hold of. And yeah, we found that 30% of these platforms that we reviewed were offering financial services and 13 were offering insurance specifically. And this was mostly third-party liability cover and personal accident insurance for workers, and really just reduced the risk of transacting on the platform for all the users involved. So now I'm going to talk you through the first case study, which is an example of one of the online platforms we analyzed. So Clark's is essentially an online platform for renting construction tools and equipment. They aggregate suppliers, providing consumers with simple, accessible information on the equipment availabilities, and it really just makes it easier for them to compare prices, and assess quality from what would have been a very large and fragmented pool of local suppliers in Germany. So the platform has really created value in Germany's construction sector by simplifying the rental process for consumers and equipment suppliers. So Clark's partnered with HDI Insurance to create a unique insurance solution to cover accidental damages to equipment rented. Clark's essentially manages the policy and pays for the insurance by incorporating the cost into the commission fee that they charge to all users on the platform. And then Clark's also handles all the claims, and they do it digitally, and this really improves the efficiency with which the claims are managed and processed and also assessed, which reduces the claims management costs. And what's really interesting about Clark's in particular is that they're not only helping with risk transfer, but also with risk management by offering various services to help businesses and individuals better manage risks. So, for example, Clark's found that smaller suppliers often lacked their own fleet management capabilities, which made it difficult for them to track their equipment. So to help with this, Clark's created a supplier and hauler database so that they could easily manage the equipment rentals online. And then they also created a mobile app to match the available equipment with haulers and to track the equipment while it's in transit. So they also developed a dashboard for their suppliers, which allows them to view and plan the projects, track their equipment, and manage all tasks, invoices, and all of those activities. So this really helps the industry kind of streamline the logistics process, enables the suppliers to better manage their fleets, and allows Clark's to also receive information on the availability of the machines. So the second case, which I'd like to highlight, is iBuild. And iBuild is a citizen-to-citizen digital platform that allows a secure method to connect homeowners with contractors, workers, and suppliers to facilitate the housing construction process in Kenya. And in 2019, we conducted qualitative and quantitative research with iBuild users to get an understanding of their realities and the perceptions of these platform users, and really understand the financial needs and the risks faced by the contractors, workers, and suppliers. And this was all done so that we could find ways for iBuild to better contribute towards the livelihoods of these workers and suppliers who are often informal and are operating small businesses, so they're quite disadvantaged already. But iBuild is now in the process of developing partnerships with various insurers to roll out some of the products that we recommended, but they recently announced a partnership with Britam to offer accidental microinsurance to informal workers on the platform. And another really interesting way that iBuild helps overcome some of the non-insurable risks in the market, notably the payment challenges. So this relates to partial or delayed payments, or when someone fails to pay completely. So this was one of the largest risks mentioned by all platform users that we interviewed. And they reported, about 70% of them reported late or no payment as a major challenge to their operations. So iBuild offers a digital wallet and an escrow account, which helps reduce payment uncertainty on the platform and also allows participants to safely store and access their funds. So these tools are really important for facilitating trust between consumers and suppliers, and they provide greater certainty to freelancers that just so that they know the price for their work won't change and that they will get paid soon after the work has been completed. And the last two case studies that I'd like to talk through today are also more related to risk management as opposed to risk transfer. So the first is called Sensor Networks, and this is an Internet of Things startup that has partnered with Santam in South Africa to provide smart home insurance solutions to homeowners across South Africa. Specifically, they rolled out a smart visa device into all homes, which helps the insurer reduce and manage the risk. And this was just it was found that visa-related issues were one of the most common household insurance claims in South Africa. And visas only have a lifespan of about 7 years. So it's likely that they are going to break or be damaged at some point. So the sensor network's smart geyser device is fitted into the electronic geyser and then linked to a user's smartphone through an app. And then if there's a leak or the geyser bursts or something breaks, the device recognizes the problem and then sends a notification first to the app, and then also shuts off the water and the electricity supply to the geyser, which prevents further damage to the home. So in addition to this, Suntam receives an immediate notification when an issue does occur, which allows them to process and resolve the claim fast and efficiently. And yeah, the company also developed an in-house algorithm and machine learning platform to analyze data from all the sensors, which allows them to preemptively prevent faults from occurring or know when, maybe a geyser is going to be faulty because it's been a really long time. And this essentially just reduces the risk for insurance providers and really provides the end users with a peace of mind. The last case, which I'd like to touch on today, is Lumkani. So Lumkani is a technology company which distributes insurance products to financially excluded households and businesses in townships across South Africa. So they specifically developed a fire detector to mitigate the risk of fires, and then also have a fire insurance product to cover the fires when they happen. So how it works is that given the fact that many households and townships use cooking, lighting, and heating methods that produce smoke, they rather developed a sensor that senses heat. So if the temperature rises in a shack, they will set off an alarm, and this will indicate that there's a potential risk of fire. And in addition, the informal settlements in most places, I guess, are quite dense. So these sensors also give off a communal alert where all the sensors within a 60-meter radius will also go off if one detects a fire. So this just allows other households within the area to become aware and buy some time for the communities to be a bit more proactive in rapidly spreading fire situations. So yeah, that's my presentation for today. So thank you.
Thank you, Lucia. Thank you for the presentation. Some of the session relatively late, so in our Q&A, if we can go over some of the earlier points in the presentation, I think that would be nice. I have a question for you about the role of insurance in general. So the role is to help minimize the risk and how people financially against the uncertainty of risk. So can you talk about the ways our world currently is increasingly risky? You said that the current models are much less efficient for predicting risks than they used to be. Can you expand on why and talk about the new risks that we are facing now and the insurance products that are available to address these risks?
Yeah, of course. So I think one of the most important class of risks that are emerging are those related to climate-related risks. So in 2018 alone, there were about 53 climate-related disasters in Africa, which caused economic losses of about $1.3 billion, and insured losses were only $0.2 billion. So these disasters are also likely to get worse in the future. So Africa is expected to experience temperature rises, and this is going to cause increased variability in rainfall patterns and a rise in extreme weather events. So climate risks are really not something that we can ignore, and given that they're such large risks, they're likely to impact all aspects of economies and communities. So they're really something which need to be addressed. And some of the interesting solutions which have emerged in this regard are partnerships, particularly between international organizations, insurers, and governments. So working with city stakeholders, insurers can identify the key actions that need to be taken to to get a city to enhance its insurability, essentially, in the face of these risks, and really have this analysis hardwired into the city's plans, which will allow them to better manage the risks. So an example of this would be the UNEP FI Principles for Sustainable Insurance Initiative, which was launched in 2012 at the UN Conference on Sustainable Development. So these principles essentially serve as a global framework for the insurance industry to address environmental, social, and governance risks. And it's one of the largest collaborations between the UN and the insurance industry. And I think about over 140 organizations worldwide have adopted these principles. And partnerships often work really well just because of the split between the roles and responsibilities. So, I mean, insurers can't take on all the roles that are needed, neither can the public sector. So, for example, the public sector would be the one who implements the policies and possibly provides some financial incentives that promote market adoption, while the insurers really focus on designing and implementing new product offerings and educating consumers on all of the issues. Another interesting example that we've seen emerging are catastrophe risk pools. So this is a model where a group of insurers will underwrite specific risks for a group of individuals, or in some cases, and for larger risks, a group of countries. So this essentially allows insurers to pool all of their resources together and avoid risk concentration, and it helps them avoid also the massive payout that's often required when a disaster does occur. And since it's unlikely that a group of individuals or a group of countries or cities are likely to all experience the same risk at exactly the same time, the diversification among the participants creates a more stable and less capital-intensive portfolio, which then is cheaper to reinsure. And then, these kind of pooling arrangements also incentivize local area risk reduction, which then further preserves the insurability of the region or the group. So one example that I'd like to highlight in this regard is the African risk capacity. So this just brings together various African countries to better manage and prepare for natural disasters. So they have a specialized agency which provides risk management advice and builds capacity in this area. And then they also have a financial arm which operates as a sovereign risk pool and essentially insures all the countries against climate-related risks. And then the last possible option, I mean, there's lots of options, but the one that we've identified is that parametric insurance could be a solution. So this is a type of insurance product that pays out when a certain threshold or parameter is hit. And it's often used in the context of crop risks. So for example, if there's a higher level of rainfall or temperatures have been very high for a long period of time, it might lead to drought or floods. But then as soon as that, if there's, for example, 10 millimeters of rain instead of 2, the insurance policy will essentially trigger because that threshold or parameter is hit, and then it'll pay out. So in the urban context, it's really good in situations where there's a mix of buildings and infrastructure that are too complex to underwrite via like a risk pooling arrangement, for example. So, I mean, an example would be in Cape Town, we are surrounded by mountains and we're often high at risk of wildfires. So if we were to have a parametric solution in that instance, the wildfire losses could be estimated by the location and the size of the burnt area. So if it exceeds a certain threshold, then the insurance companies can assume that a certain loss has occurred. And because they already know that, it avoids the need for then individuals to go and claim. They automatically know, okay, we need to pay out, and it just allows for a faster provision of funds so that recovery operations can be undertaken.
How about a global pandemic? I mean, COVID has impacted housing markets more specifically. It has impacted a lot of industry, but all over the world. It has slowed down construction, especially during lockdowns. it has pushed households outside of their homes because they couldn't pay rent or they couldn't pay the mortgages. So how has it impacted the insurance industry?
So, I mean, I mentioned earlier that it's unlikely that a lot of individuals or countries will be hard hit by the same risk at the same time. And I think COVID is the complete opposite of that. And because we're kind of all experiencing the same risk and everyone is being hit in some way, this has presented significant challenges to the insurance industry, particularly when it comes to paying out for certain issues. But more on, I guess, I'll start by just covering some of the more operational side. So most insurers had to stop their operations or switch to working from home as soon as countries went into lockdown or certain activities were restricted. I think in some cases, insurers were allowed to operate as an essential service provider, which did help. But in cases where they weren't, they had to very quickly just switch to working remotely, which I think some did better than others. So, I mean, we did a survey across insurers in Eastern and Southern Africa, and we found that about 95% of them had to switch their model to enable remote engagement. So, you know, like buying their staff laptops or setting up VPN connections, things like that. I think in one case, even they had to ensure that the electricity supply was stable. So they bought a generator for their workers who all lived within a certain area. So that was really, really interesting. And then there's also been a significant reduction in the number of new policies that have been sold. So insurers in Africa particularly operate very, they rely on in-person engagement to sell policies. So it's often through agents who will approach individuals and try and sell. So this was obviously not possible during COVID because of the restrictions in place. So yeah, there was a huge reduction in sales. It also impacted the launch of new products. So not many products were launched at all, but they did add on some benefits to existing products. So for example, free COVID-19 related benefits on existing life insurance policies, or sometimes they may be tailored certain policies to be provided to frontline health workers in the crisis. I think another major way through which insurers were affected was just the reduction in premiums. So obviously everyone has been impacted by COVID, and in a lot of cases, individuals' incomes or even businesses' incomes have been constrained. And I think particularly when it's low-income individuals or smaller businesses, insurance will often be the first thing to go because, you know, they need to maybe shift all of their money to feeding their family. So in some cases where insurers were collecting premiums digitally, like through mobile money or just through bank transfers, it was less impacted. But then there's cases where, especially for microinsurance, maybe individuals top up with their airtime, but then because of the restrictions, they couldn't go and buy airtime anymore. So they weren't able to pay their premiums. Or in cases where the agents came and collected cash from individuals, then this was also no longer possible. But what we did see is that insurers quickly started offering relief measures. So premium holidays for certain policies, in some cases reducing the premium amounts, and then also offering more flexible premium repayment periods. And yeah, the slowdown in sales and the reduction in premiums also had quite a negative impact on insurers' liquidity and their ability to maintain their short-term operations. So a lot of the insurers were vulnerable financially before the pandemic. And yeah, I mean, COVID is really gonna increase this vulnerability, and this may lead to weak insurers being pushed into insolvency, and then yeah, a certain extent of consolidation of the insurance market. And then I think, yeah, just one last thing that I'd like to particularly touch on is just an erosion in trust, especially on the business side. So this is a huge challenge for the industry because it's likely to I mean, people already don't trust insurance. Now, in cases where they weren't covered, it's likely to increase the lack of trust. So many of the policies, especially on the business side, had pandemic excluded. So this means that the insurance sector wasn't really able to play a role in enabling business resilience. So I mean, in South Africa, you know, you kind of take out this business interruption insurance, which covers you in the event that your business is interrupted. But then because pandemics are such a global, or not a global, but I mean, it's impacted everyone. So insurers aren't able to manage all of these risks at the same time. So this is one reason why they don't cover it in the context of business insurance. But yeah, I mean, yeah. So in some cases, they have tried to be more accommodating by paying out for certain things or only certain clients, but it's really had an impact on the way that people perceive and trust the insurance industry. But on a slightly brighter side, and not to sound insensitive in any way, there have been really good opportunities that have emerged from the crisis. So there's been a huge shift to operating through more digital channels, and I think 66% of the respondents we interviewed have digitized or are in the process of digitizing their operations. So while this initially increases their expenses, in the long run, it can really help insurers become more efficient and reduce costs in the long run.
On the brighter side as well, since insurers have supported the enabling of working from home. I mean, working remotely is mostly, for most of us, working from home. Maybe we have a new reason to protect our homes and insure them better, also from the point of view of employers and insurers. I would just like to remind everyone that questions on the chat are welcome. We'll take them into account and we'll make time for them. I want to go back to the different risks that were mentioned in your reference. Political risk insurance. What types of losses does political risk insurance cover?
Yeah, so political risk insurance essentially provides financial protection to investors, financial institutions, and businesses or individuals in the face or if they face the possibility of losing money or assets because of political events. So some examples of such events can be if the government confiscates business or an individual's property, and also acts of political violence, whether it be civil unrest or even acts of terrorism in some cases. So I think there's about 23 terrorism risk pools or reinsurance mechanisms globally. And one that is particularly interesting is in South Africa, which is Sasria. And this is owned by the government and offers a short-term specialist risk insurance to municipalities, schools, hospitals, individuals and businesses, essentially organizations that own assets that they want to protect. So their business model essentially works is that they enter into agreements with other short-term insurance agencies who offer the special risk solutions, and they rely on these insurance companies for the operation of day-to-day administration and collection of premiums. But then the Sasria, their role only comes into effect when a client needs to claim or a claim needs to be settled. So their structure is essentially a membership network pool that includes all the short-term insurance companies who pool their resources together to pay out in the event of a claim. And then if that claim is perhaps too big and the damage is too large for them to cover, the Minister of Finance will step in kind of as the insurer of last resort, and they provide a stop-loss cover in excess of what Sasria can provide. So, and how a stop-loss cover works is just that they agree to cover damages up until a certain amount, and after that they can't pay out anymore. And the stop-loss model just provides a bit of additional protection to the insurers or the other agencies that are providing the resources, just so that they won't be completely wiped out in a sense.
You mentioned that insurers' business models are unsustainable, that we're working right now with models from the past. What are some of the challenges that you have seen emerging in this regard?
So I think the main challenges that we see emerging are particularly with regards to the challenges in providing climate risk insurance, but I think that this would be applicable to larger risks and also risks that apply to urban resilience. So the first is particularly a lack of data and models. So this lack of data essentially hinders stakeholders' ability to manage large risks. It's also difficult to design risk models, especially for large risks or when there's insufficient data on the exposure to different risks. And there's also not all of the data is accessible across sectors, and then sometimes not even accessible between different types of organizations, often due to different data requirements and capabilities. So in addition to the limitations with insurers' current models, which I mentioned during my presentation, they are also particularly reliant on reinsurer and broker catastrophe models to manage such risks. But there's often a lack of transparency on how these models are built or where the assumptions are, which makes it particularly difficult for insurers to move into new risk areas. And then government and city officials particularly often lack a solid understanding of compound risks or more complex risks when they're interrelated, which affects their ability to make informed decisions on how to manage these disasters. And in some cases, and I think particularly in Africa, they often don't have the resources to collect the necessary data, which results in insufficient data. And this is further undermined by the high level of informality, which makes data collection often impossible in some cases. And then, urban experts also highlighted that their data and models are often fragmented and also can't take complex risks into account to determine how all the different dimensions affect one another. So, factors like urbanization, land reform, and immigration all need to be taken into account when looking at how to manage risks or cover risks, but this isn't always done. And I think the second issue is just poor collaboration. So there's a general lack of collaboration and knowledge sharing within the field of disaster risk management. And a lot of organizations tend to work in silos with limited cross-sector and inter-sector sharing of knowledge and resources. So often scientists or experts will gather and analyze evidence, but their findings won't actually reach the people who it needs to reach. So, city officials or municipalities, etc. And it's also, I think, particularly difficult to influence government or city decision-making processes because they sometimes have conflicting interests or, different priorities that limits their ability to quickly act on the evidence that they are provided when it comes to these large risks. And in the case of insurers, it's particularly difficult for them to partner with governments because of the time delays, different operating models, and then the lack of data that I mentioned above. And then I think one of the other challenges that we identified are just misaligned incentives. So establishing a business case for urban resilience really requires a better understanding of the interests and priorities across different stakeholders in the urban development process particularly. But often these interests don't really align. So as I mentioned above, governments or city officials often have competing demands for their budget and priorities. And I think, focusing on risk management is really more of a longer term process. So it often gets overlooked between the things that require immediate attention. Infrastructure or property developers would also face higher short-term costs for upgrading design, for example, like having more sustainable building practices in place or developing green buildings. And then it's also quite costly for them to implement these and adapt their policies and risk management practices in the long term. And then, the owners and managers of assets also, need need further investment or resources to make existing infrastructure more resilient and adopt the right risk management practices. So yeah, it's quite costly, and it's also not always clear to them what they need to do. So yeah, these are the kind of ways in which the incentives don't align.
If you were to imagine ways to overcome these challenges, I was drawing the parallel with the finance sector or the credit sector, where some countries have an obligation to have a credit bureau where some of this information would be available to all of the banks, so that they could limit their risks as well by choosing who to lend to. So what you're saying is that there's nothing of the sort in the insurance world, in the insurance industry. There's no collaboration or sharing of data that is mandatory by some governments.
Yeah, I mean, it's definitely limited. Yeah,
it's limited. Okay. There's a question on the chat by Olivier, and so his question is: you mentioned the risk of trust erosion. This is particularly important in Africa, where insurance is often not mandatory, therefore not as well regulated as in other parts of the world. Could you talk about the role policymakers and regulators are playing and can play on the continent to develop or strengthen the sector and build trust? And somewhat related to this question of trust, actually, is the question of market penetration, because the fact that it's not always a requirement, a legal requirement, to have some types of insurance as opposed to other markets outside of Africa, maybe that's a reason for the low rate of market penetration. If you can address Olivier's question, and then maybe we can talk about market penetration more specifically and some other challenges in addition to the regulatory context.
So so as you mentioned, we do have a very low insurance penetration, and I think the reasons behind this do speak to some of the trust issues, which I'll touch on now. But just to put it into comparison as well, so we have an insurance penetration rate of less than 3%, or it was in 2017 when the data was collected. And yeah, if we look at Latin America, for example, they have an insurance penetration of just over 3%, but then China has a penetration rate of about 4.2%, and then for developed countries like Europe and North America, it's high at over 6%. So we really are lagging behind in terms of the insurance market development. And there's a few key reasons behind this. And I think just touching on the trust erosion, at the moment, the current way that insurers are operating and their business models are not geared towards, I guess, low end or difficult to reach consumers, especially in developing countries, and particularly in Africa. So most insurers are operating, they're kind of like in the early stage of development, or the markets are in the early stage of development. So their business models are kind of geared towards large corporates or wealthy individuals, and their financial stability is such that they're quite reliant on high premiums to keep operating, because their investment income isn't they're operating at a loss, essentially. So they don't have the necessary resources to often expand the reach to provide solutions for low income consumers. So this is a huge barrier to them making the necessary changes to reach customers. But then often the solutions that they do provide don't speak to the needs of consumers and don't take all of their realities into account. So I mean, in Africa particularly, most consumers are on the lower end of the income scale and are operating informally. So they are generally not aware of insurance, but then they also tend to rely on like suboptimal coping mechanisms, such as their savings or borrowing instead of insurance. But this is also because I think in a lot of cases, they can't actually justify the paying something every year or every month when there's an uncertain risk. You know, they'd rather put that money away to more immediate needs and then kind of just deal with the risk when it pops up. So, I mean, there's a real need to kind of find new innovative ways to reach consumers that are, you know, like providing lower cost solutions. And really just, yeah, there's also a need for insurers to educate consumers on the need for insurance, but yeah, also for them to adequately provide value for the consumers. So yeah, I think also in Africa, there's poor infrastructure and distribution channels in general. So the poor infrastructure limits the number of touch points that insurers can have with individuals. And they often, in certain markets, you know, it's very rural or individuals are spread wide apart. So it costs more for insurers to find ways to reach all of these individuals. So, I mean, I mentioned that insurers often rely on agents, and this is really, agents and brokers are the main ways through which insurers distribute their insurance. But this is very expensive and often limits the extent to which they can develop new and innovative solutions. But then they're also constrained to some extent by regulatory challenges. So a lot of regulation is still quite outdated, and especially with the increase in digitization that we've been seeing lately, the regulation hasn't been updated to incorporate some of the new and more innovative ways that consumers could be reached. So I think in a few markets, we're seeing a rise in insurance distributed through mobile money, but then in some cases, there's still barriers to insurers selling insurance through remote channels. And yeah, I think this all limits the extent to which consumers can be reached and yeah, essentially the trust that they have in the industry.
If I were to sum up the reasons for a low market penetration in Africa, we talk about the distribution channels, the low trust, the regulatory framework, sometimes the high cost, and maybe education or culture, the culture of insurance that is non-existent or that is very weak. I have one last question for you for the 3 minutes we have left. So if there are any other questions on the chat, they are welcome. I want to ask you about housing finance. So as you know, homeownership is very difficult to attain without housing finance, unless you are going to build yourself incrementally. So the investment represents years of labors, and savings are not sufficient to cover a lump sum payment to a developer. So housing finance is therefore in the housing value chain. How can insurance play a role in making housing finance more accessible?
I think there's actually two more roles that then I highlight that insurance can play in the development of property markets. So because insurance acts essentially as a guarantee against defaults, it can help secure access to finance. So in a lot of cases, having insurance is often a prerequisite to getting a mortgage. And also, I know in a lot of cases, if you take out a loan from a bank, you're often required to get credit insurance. And as I mentioned, this really just protects the bank or the lender from the event that you're not able to repay for some reason. And I think this would particularly be useful in more developing country contexts where most individuals or businesses are already informal and quite small, so they're generally considered to be quite risky. So if there were insurance solutions, and this would really have to be more of an inclusive insurance solution, then it would help these lower end individuals or businesses gain access to finance, particularly for housing. And then the second way would be that insurers themselves, as institutional investors, can be a source of financing by investing, for example, in real estate investment trusts. So this is essentially a company that owns and in most cases also operates income-producing real estate. And this can be across a wide range of different types of buildings, so offices, housing, warehouses as well. And then, just essentially by leasing space and then collecting the rent on this, the company then generates income, which they then pay out to the shareholders in the form of dividends. And one particularly interesting case, which I'd like to highlight, is just the Watumishi Housing Company in Tanzania, which is a property developer, but also a licensed fund manager of a Watumishi Housing Company a reinsurance or real estate investment trust. So as a property developer, the company is the main implementer of the Tanzania public servant housing system, which is an affordable housing scheme offered to public servants. But then they also have a partnership with banks, which lowers the cost of mortgages, making housing finance easier for individuals in lower income brackets. And I think, for example, if an insurer were investing in this business, it essentially helps expand the provision of low or more affordable housing to low income individuals.
Thank you, Lucia. This is the end of our discussion. There were no more questions on the chat. So to you, Olivier.
Thank you so much, Munia and Lucia, for an excellent presentation and discussion. It was really interesting. And I'm sure I see actually there's some request to direct message and direct engage with you. So if you have some time to continue the conversation and network with our participants, that will be truly appreciated. It's really a fascinating topic for me. And it's a bit, I think, like you mentioned, Munia, a bit of a chicken and egg conversation, right? Clearly in Africa, the insurance sector it also rely a lot on the housing sector because it's one the only few sectors, whereas the housing finance sector and the housing sector, that are some sort of like a condition and regulation and incentivize people to get insurance. And at the same time, they needs to increase its asset base, right? To also play its role on the other side as an institutional investor to then reinvest in the housing sector. So it's really a vast topic, and the insurance sector has a key central role to play on both addressing the risk and also providing playing its role of an institutional investor in providing long-term finance on the sector. So thank you so much for a fascinating conversation to be continued for sure. And thank you again, Lucia and Munia. So we are it was the last session of the day. Thank you. It was a fascinating conversation today. We resume tomorrow at 10 o'clock in the morning with the last day of the conference. Tomorrow we'll focus on supporting market development. And we want to thank again our sponsor, the AFDB, the IFC, Real, I don't want to forget anyone, the iBuild, Ilama, Land Afrique, for supporting the conference. We look forward to engaging with all the participants in the networking session. Please visit the booth, the expo session as well, and have a good rest of the day. Thank you. Thank you.
Thank you.
Thank you. Bye.
Bye.